Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about how to interpret the jobs report, the 10-year yield, and what he expects to see as far as demand ahead of the spring home buying season. Logan, welcome back to the podcast.
It is wonderful to be here on Jobs Friday.
It is great to have you. We had a really fun last time we were on here when you talked about the silver tsunami, and boy, did we get some feedback on that. That was great.
Yeah. See how much people love Logan Unleashed. Sarah, can we remember that, especially when we go on the Nord tour across all these cities? Just let Logan Unleashed on every city. It'll be a lot of fun.
I will remember that. Yes, as someone noted before, I'll take that into consideration. But that was a great podcast, and this is going to be a great one because we're talking about jobs and what this means for mortgage rates. So first, break down the jobs report for us.
Yeah, it was a really interesting day for the bond market, mortgage rates, because we had such a wild kind of spread on the 10-year yield. The headline number beat right away. The 10-year yield went up to about 4.8%. And then people started to read the internals of the report. Bond yields started to come down. And then the ISM report, especially the employment index, just tanked in a very aggressive fashion. And then the 10-year yield shot right back down. And then the 10-year yield went up back above 4%. The last quote is 4.04%. So everybody's trying to make a lot of, it's so funny. We go from, the labor market's strong. The labor market's weak. Oh my God, we're going into recession. The bond market, so let's calm everyone down, breathe, and let's keep focused on, eye on the prize. The labor market is slowing down as it should, right? And I just want to let everyone know, just remind everybody of our economic work. And I'm going to say we, not I, Sarah. Okay. During the COVID-19 recovery, it was basically, because I work off economic cycles first, I'm a housing person second. The COVID-19 recovery was going to be sharp and fast. Once we retire the COVID-19 recovery model on December 9th, 2020, we said a few things on the labor market. Number one, job openings are going to get to 10 million, right? Something that nobody ever believed, not even the job openings people. We got to 12 million. That 12 million number is now down to 8.8 million. That is actually, on a nominal term, that's a very big drop. But this week, what we saw is that the quits ratios, the things that the Federal Reserve wants to see, they want to see the quit ratios come down because the Federal Reserve wants you to earn less money. Wage growth in their eyes is bad. Too much wage growth. So wage growth is slowing down, not as aggressive as some people would like to see, but we're still running at 4.1% or 4% on the BLS numbers. So the quit ratio is pre-COVID levels. There you go. That's what the Fed wanted. That was one of their check cards. Then the hires in the job openings levels is below COVID levels as well. So the internals of the job openings data is getting softer, not breaking, but softer. Then we have the ADP report. I always tell people, out of all the 4 jobs in Jobs Week, ADP report, not the most valuable one. So we don't spend too much time on that one. But the jobless claims data, now this is the key. Everything revolves around jobless claims data. Why were all the recession people wrong? Because they didn't have a point in reference on when the labor market needed to break or a number to use. So they just went with the recession of all of 2023 and it backfired on them. We don't really want to get into a recession talk until jobless claims break over 323,000 on the 4-week moving average. That number, good. We're almost back below 200,000 again, right? 10-year yield went up on that, as it should. But this report right now, the internals are just slowing down as it really should have. And I always go back to what I talked about a while ago. We are going to get a lot of jobs until we get to about 157 million to 159 million. We're already above 157 million. At that point, the jobs data is going to just naturally slow down. Population growth, the baby boomers are leaving, all that stuff. That would be pretty normal. We're in that full stage right now. But some of the internals are showing a little bit more softness, but not breaking. And hopefully that could, the 10-year yield rising the last few days because the labor market is good. Looks perfectly normal because the labor market isn't breaking. It's getting softer. So the Fed should have its hello McFly moment and realize that the growth rate of inflation fell without a job loss recession. So we don't need to jeopardize the labor market for you to not get your 1970. So I'm hoping that this year, bad Fed, good Fed talk, they start doing the rate cuts and then we start to get something very productive going into 2024, but also into 2025.
Okay, so what is ISM? You said the ISM report. I don't know what that is.
It's there's these manufacturing service index prints, whether it's manufacturing or the service side. That's the service jobs print. Usually, this thing starts to break very fast in a recession. It was a very, very, very fast break lower in that report, which might be just a one-off. But if I was the Federal Reserve and I'm looking at that, I'm thinking, whoa, why are we playing with, oh, wait a second, we're old and slow. We don't care. Yeah. So this is not, the bond market had a very sharp reaction to that, but I'm a claims guy. So of course, I think the Fed should be cutting and should cut 75 basis points just so we could get something to neutral, as they told us, or unless they Fed wanted to lie to everybody about their core PCE talk. So slowing, some weakness internally, not breaking. The 10-year yield, again, 4.25 on the high end, 3.21 on the low end. Gandalf line is still there, 3.37. As long as the economic data stays firm, we should be in there. If the 10-year yield goes above 4.25, okay, to me, the economy is outperforming. You could definitely on a technical basis look at 4.40% if we hit the upstream. But I think this is one of these days where I look at financial Twitter and I see all these smart people and everybody's trying to make something, and it's just a lot of noise on one report. So let's take them all together, right? The job data is slowing down, not breaking, slowing down. The quit ratios are back now, right? So the employer, the bosses have a little bit more advantage now than the employer. We always say the labor market, a tight labor market is good for everyone because, it gets wages going. The Federal Reserve doesn't want that, guys. No, you getting wage growth? No. We have to make sure that everyone stays in line and nobody starts quitting their jobs and forcing people to bid up for wages. We won't tolerate that. So I think that's a simple way to take it. Softening looks normal to me. Breaking, no, not with jobless claims this low. When jobless claims break over 320, I will sit here and have this entire new discussion, but we're not there yet. Mortgage rates have made, of course, a very big move lower already on a technical basis. We hit a very key level on a 10-year yield. We bounced off of that. So we focus on all economic data 24/7. We hold everyone's hands. We're not going to abandon you. We're going to talk nerdy 24/7. We're going to guide you through this every single day to try to make sense, because it has been very crazy after 2020. And I understand why there's a lot of confusing discussions out there.
Okay, so let's talk a little bit. That 157 to 159 million, that is just getting all the jobs lost back from COVID, correct?
No, I mean, that's not all the job. That's where, so the best way how I explain this is that if there was no COVID-19, let's say there was no COVID, never existed, and we were still running with the longest economic and job expansion ever recorded in history, that's where we would be today. So we just officially broke through the makeup labor ban. This is just my take on this. This is why I've said, we're just going to have these big numbers until we get to past 157 million. And then the labor data should slow down, right? Population growth is slowing here in the US. The baby boomers are leaving, right? So it's really hard to have really big job numbers in that backdrop. So that's why I always say, once we get here, we should slow, and we have been slowing down. We've been slowing down for 12 to 18 months. We always get these negative revisions on the labor part. It looks normal to me. But people last year took negative revisions and everything and just went straight into the recession mode. That's just a lack of experience, right? Or as I call Wall Street, because Wall Street is called a recession every year since 2010. And they're just oh my God, do you guys realize this? That after 2010, every recession call on the economic side was incorrect, Wall Street. And they sit here talking about this recession, and it never happened. And it's not like these people ever get fired. You could be really bad in calling a recession and you'll probably get a bonus in Wall Street, right? Just let me explain to everyone. Wall Street is full of it. It's a marketing thing. If you notice why a lot of people are very bearish, they just want you to get you in, right? It's like the silver tsunami. Ooh, here it comes. Silver tsunami. New listings data trending at the lowest levels ever recorded in history. You can be this bad on Wall Street and get away with it because they want you in. They got to lure you in. Pinocchio, come on in. Come on in. We got a fun time here, But every single recession call has been wrong because it was COVID that gave us that very brief recession. And then some crazy person wrote a COVID-19 recovery model on April 7th, 2020. So things are a little bit different. Just remember, try to stay away from the noise and focus on the things that matter. That's my job. My job is just to hold everyone's hand. And remember, because there's a slow dance, that slow dance between the 10-year yield and 30-year mortgage rates. That's what matters. That's why we have to focus on what drives the 10-year yield. And we're kind of in the upper band of the range for 2024. And again, to me, anything above 4.25, the U.S. economic data has to be outperforming in that sense to get us there.
So you said job openings 8.8. So you were one of the very few people who said JOLTS 10 million. I mean, you were doing that. I remember when you went to the beach and you wrote it in the sand, and it went on Instagram because you were like, we have to get this makeup demand in jobs. And then it went past 10 million, went to 12 million. Now we're at 8.8. What does that mean to you?
Well, here's the thing. Everyone hates the job openings number except the Fed. And I love it. I love the job openings number because like in the previous decade, I always said like my target is like, we're going to get to 6.21 million. Everybody's like throwing tomatoes and cabbages. There's 96 million people out of work, Logan. What do you mean? And it's like, you guys hang around with a bunch of losers, right? Like I always say, like, who are the angry men in this world? Are the sexless men who don't have a job, who don't have their life together, and they don't know why women won't get with them. And they're always angry. There's 96 million people. No, dude, it's just you. Get a job. Get your stuff together. Women, see, one of the things I love about America, so many things I love about America, but our women kick ass in this country, right? They're more educated than men. They're harder workers than men. And they do not need to sit there and like, the guys think it's like 200 years ago where I'm just a man and you have to, no, women got much more game. So guys can't keep stepping up. So there it is. You got problems. So they think 96 million people are out of work. That's a whole gimmick line that was used in a previous expansion. So job openings, the Fed does not believe you could have a real big job loss recession with job openings this high. I would argue a different thing. If you take the trend line of job openings from 2008 and just draw a black line, Sarah, you know how much I love my black lines, right? We just draw that black line.
You love to draw black lines on charts.
Yeah, yes, we're pretty much where job openings should be. And consider this: every single month, baby boomers leave, right? They go. I hope some of the Fed people go with them, but they're still there. And then what occurs is that job opening looks pretty normal to me, but the quits ratios and the hires are actually now pre-COVID levels. So that extra buffer that some people think we might have is not really there as much. There's a lot of people that just don't like the job openings because they think that it's over exaggerating. And in some cases that's true. But listen, we had a very tight labor market. Wages went up. Job openings was high. Just go with that. But the internals of the job data is getting weaker now. So that's a material thing, at least for me. And I'm the job openings guy. I'm the 10 million job. I mean, do you know, it was, I think it was May of 2021. We had a missed jobs report and I like tripled down on the job openings, 10 million call. I was like, no, we're paying people not to work. No. I said, nope. We're going to get to 10 million job openings. Literally, there's parts of the U.S. economy that can't function right because of COVID policy. So when that gets together, we're going to get there. So the internals are softening there. So I think we're just in this spot right now to where people see the jobs growth slowing down and the negative revisions, and they think that's breaking. Not there yet. When we see breaking data, boy, jobless claims just breaks. Right. And the reason I take that 323,000 number, okay, because we don't make stuff up here. If you take the civilian labor force, you ratio it to the unemployment jobless claims number, there's a certain percentage that happens in every single recession. We're still very low on that. So we still have a ways to go. Once we break above 300, then we'll sit here, we'll talk about recessions, but we're not there yet. And this is part of the reason I think if jobless claims were running at 300,000, I'm telling you, the 10-year yield is fighting that Gandalf line right now, right? We're just pounding in there and seeing we're not there yet. So we haven't broken in the labor data.
So this is a good thing to bring up because I do think that when people saw the headline number here, I think what I saw was people saying, "Oh my gosh, were we too optimistic about where mortgage rates were going to go, or if they would get there quicker?" Because I mean, everyone in our industry, we need those mortgage rates to come down, right? I mean, housing people need mortgage rates to come down from where they've been. So we're very optimistic. So, from your perspective, you would say, "Calm down, it's fine, nothing's changed on that
I mean, to me,
level."
everything looks normal. If anything, because of the job openings data, labor is getting slightly weaker than maybe some of the more bullish people have thought. But outside of that, it's a trend, right? And consumption. See, the thing is that this is the reality, Sarah. Every part of our economy has functioning demand. Even the new home sales market is relatively doing better than the existing home sales. The existing home sales market is basically at the levels where the great financial recession is, right? It is depressed levels. And we have a lot more people working now, and we have a lot better demographics than we did back then, right? So this is a sector, and I'm telling you, the Fed doesn't want to talk about this. They're so uncomfortable because I don't think they get it, right? I think they've always been so uncomfortable talking about housing because I can just see the internals. It's just not quite there. And here's one sector where we actually do need lower rates. So of course, short-term rates didn't create a recession, but long-term rates created the housing recession. This is why I always say I haven't even taken my housing recession call off, right? Because it's based on the existing home sales market. New home sales are growing double digits. Builders permits are growing. That's fine. That's the economy. In fact, this was one of our readers actually said, you know what? I went back to your 6 recession red flag model, and you had these 2 things that needed to happen for the economy to make sure it's not goes into recession. Number one, rates have to go down. The 10-year yield did fall. The builder surveys went up. The builders started to provide lower mortgage rates. So in a sense, the 10-year yield and mortgage rates are lower for them. The new home sales means a little bit more to the economy because of construction jobs, big ticket items, right? Those things are different, where the existing home sales market is basically a transfer of commission and moving trucks, right? So the 2 different sides. So that worked. Then the growth rate of inflation had to fall. That worked. And let's remember, in 2022, literally people thought Europe was going to freeze to death, and the war in Russia was going to get bad, and oil was going to go up. So there was a lot of negativity back in 20. The growth rate of inflation fell. That's good. Then it's number 3 was like, hey, we need the Fed to stop hiking rates. There we go. We got them. But the last one, we need the last one to get a soft landing. Think about it. Why? Well, just let it happen. Let the soft landing go. Cut rates. Talk dovish. Get the bond yields down. Nobody's going to die. Inflation's not going to take off again, right? Make everyone happy. So it's just these last little things, right? Because honestly, if the 10-year yield was below 3% and the spreads were better and people were buying homes, even my most aggressive recession Wall Street types would probably say, oh, that's not happening this year. Everyone's hanging on the housing market to create the recession. So I think that's just the last piece right here. So we've got everything in there. We just need to cut rates, bond yields to go down. People buying homes, right? Buying homes, having sex, having kids, living the American dream. This is what we do. And we're sitting here, we're like, but the 1970s, the world got up to the... So we're still dealing with that crowd. So once that's over, we're good, right? So we're almost getting there, but a little bit more work has to be done.
Do you think the Fed will cut rates at this meeting?
I believe March is in play. I think we have, of course, the CPI data. They are too restrictive based on the models they told us. So I'm not saying this because Logan Mohtashami wants rate cuts. They gave us a model to work with. We're doing it, and everything that happened. So they're obviously not hiking anymore, but the growth rate of inflation fell more than they thought, and it didn't create a job loss recession. So here it is. You have the victory. It's like Jay Powell's the pilot, and they're landing the plane, and somehow Jay Powell jumps out of the plane, goes in, turns off the lights to the landing area like an airplane, and I'm like, that guy, and he doesn't want to do it. Just land the plane. Come on, what are you doing? Why are we talking about the 70s still? What's up?
I really appreciate all the airplane references. That is a very funny movie. I haven't watched it in a couple decades, so I don't know if it holds up. I don't know if it's one of those that you go, oh no,
It
can't be that
holds up. It holds up. It holds,
It
because
does.
every time I see it, Jay Powell, the barking. Look at all these Fed members are right here.
Oh my gosh. Okay, well, what else? What else is going on this week that you want to talk about?
Well, number one, we're now starting the new year. So again, housing is very seasonal. So we're going to do the tracker. And I think the tracker, the inventory, like for me last year, going on CNBC and telling people, I think new listings data is going to grow, right? Because we haven't seen another leg lower and we're working from the lowest levels ever. Like we are so depressed on new listings data. Silver tsunami didn't work. But we're so depressed there that, we have to be able to grow just a little bit, just because I think that was such a one-off after July. So we want to see new listings data grow. We want to see new listings data get back to 2021 and 2022 levels. So the tracker article is going to be very critical. Active inventory. What I hope is active inventory bottoms very soon and then starts to rise. That's what I want. I don't want active inventory bottoming out in March or April. We want to get, remember, supply is a function of demand unless you have a recession, right? So we want more active listings, more sellers that are buyers. This is the one thing. Remember, for everyone here, active inventory grew for 7 years from 2000 to 2007. Prices didn't fall, in that period of time. So in that context, what we need to see is active inventory grow, demand grow, positives for the housing market, because then we don't have the savagely unhealthy, too many people chasing too few homes. This is what we just need to get off of these low active listings data. I had a really good question. One of the crash addicts today. Well, what about monthly supply? Monthly supply is a function of demand. It must be high. I go, dude, monthly supply is at 3.5 months. So I took the monthly supply data of 1999 to 2014. And the annual monthly supply for the NAR data was actually 4.7 months during the period that had this record-breaking demand because it was a credit base. So monthly supply is lower than that, but wait a second, sales are much lower. Yes, just because active listings are very low out there. So we want to see going out especially in the next 4 to 5 weeks. We want to see the seasonal bottom happen soon. We want to see new listings data grow because they're working from depression levels of new listings. Sellers or buyers, get something going in the housing market. And then imagine the 10-year yield falling and mortgage rates fall, more demand, people buy homes, the world's happy, the Fed landed the plane, and we can move on throughout the year with a little bit more cheer. So it's very key to follow the tracker. We're going to get that out this week. By the time this podcast comes out, you've already read it. But especially the next 3 to 5 weeks, it'll be key. We'll see the purchase application data. We'll see how it goes. Remember, I'm not one of these really big housing rebound demand people because of, the affordability is an issue. But we are in a much better place than where we were at 8% mortgage rates. Get a little bit lower, but we're kind of still stuck in this low 4 million range. I think now that we're in 2024, everybody could realize why for many years I just said this area is just really hard to break under, right? Because there's that core buyer, that 4 million core buyer is there. And when you think about existing home sales and new home sales, you put them together, we're roughly not at 5 million, we're headed toward 5 million total home sales in 2023. So just lower rates, more demand, land the plane, everybody's happy, nobody needs to lose their jobs. Do it, Jay. Jerome Powell, just go with it.
So on the tracker, as Logan said, you write this on Friday night, Saturday morning. We publish it on Saturday afternoon around noon or a little bit later. And it goes over things like the 10-year yield, mortgage rates, inventory, purchase apps, and then what's coming next, what to look for. So let's talk about purchase apps a little bit, because that's a key level you're looking at. And it was really different at the end of last year and the year before. It kind of broke the pattern. What do you see this year?
It's funny because post-COVID, every year we've had a run in purchase application data. So we that happened again. I never count the last 2 weeks of the year. Anybody who does that, if you want to show your rookie card, I am a rookie. I put value in the last 2 weeks of purchase application data during Christmas and New Year's Eve. There's your rookie card right there. I saw that on Twitter. I'm like, in any case, we had 6 positive trending weeks when rates were falling, right? So what I joked about, we want to get people reading and counting. Oh my God, Sarah, if I could get a country to read and count, I'm ecstatic.
Doesn't seem like too much to ask.
I'm just like, come on, you're an adult, dude. Seriously, second grade education, you could count. So if we take the 6 weeks of falling mortgage rates and application data, it was positive. It was a positive trend. We take the last 2 weeks of the year out, and then I usually don't even count the first week of the year. What we want to see is the second week of January to the first week of May. We want to see growth. We don't want to see like it going nowhere or flat. We need to see this data line growth. And this is why I say that mortgage rates, if we didn't go to 8%, we're still relatively high right now, right? So can we get growth? Now we've had some growth when rates fell, but also we're working from a lower range. So we have to get that equilibrium of rising purchase application data, second week of January to the first week of May. After May, volumes fall. So it'll be very imperative to keep an eye on how the market reacts to 10-year yield moves. Because when we've seen this, when the 10-year yield rise, we see weakness in demand. When it falls, it gets better. That has stayed constant after kind of 2010. So that's why the tracker is designed to keep everyone, because, we literally basically were flat for the year last year. Like we had 23 positive prints, 24 negative prints, and 2 flat prints and that was with mortgage rates with 6 to 8%. Imagine mortgage rates heading below 6%, a trend for a year, right? The new home sales sector has shown us you can get growth in that environment. And it's not asking much at this point. This is why I really want people to press the Fed on this. Like every sector of the economy is on demand side looks fairly somewhat normal, but the existing home sale market isn't. And now that the growth rate of inflation fall, what do they believe in that? And housing is such a big component, not only to the economy, but also to the general public right there. And we got to get people moving, buying homes, doing their things. That's, a young country, household formation, buying homes, having kids going to school. This is what we do, right? And we're not fighting the 70s wars, but with that aside, that first few months of purchase application data is really key. We make some seasonal adjustments and stuff like that, but we always want to see that relationship between the 10-year yield and 30-year mortgage rates and what it does to the data. It was really noticeable last year. Like rates fell down, demand picked up, rates went up, demand fell. So it's just, and altogether, not much happened that year, but we need to have growth. We need to have at least majority of the year have positive purchase application data, because you're working from such a low level. Like it literally, when I tell people we're working from the lowest levels ever, I'm not joking. I take the civilian workforce, how many people are working, this is the lowest demand in housing ever, right? It's a very low bar. We should be able to break it, but we do need that 10-year yield to fall. We do need mortgage rates to fall when we get some traction on that. We saw that toward the end of last year. And hopefully we continue that going into 2024.
Hopefully we do. Logan, thank you so much for walking us through the jobs report and all of these things we're looking at. The main message again, calm down, land the plane. It all looks normal. And I will be looking at the tracker probably tonight. You love to look at all the data on a Friday night. And
because that's what I do on Friday nights, baby.
That is what you do. So everybody can look at that. I also would say to everyone, look out for the gathering. That is we have consolidated our events into one event for both real estate, mortgage, and then also, as always, appraisal, title, everybody in the housing ecosystem. That's going to be in April. Logan is one of our keynotes. It's going to be amazing. He has a special thing planned for that. And then we're going to close out that conference the same way we did the HousingWire Annual, with a live podcast where people can join us and talk. What will not be the same is I will not be losing a contest on this stage this time, like apparently I did last time. So, but I would say we are running out of...
Sarah, people are asking me for that video of your brutal defeat about the mortgage rate lockdown. And you keep on telling me it's coming and it's 2024. So I just want everybody to know that's people that are asking me. It's not me. I'm asking Sarah every time, where is it? I think she deleted it somehow. It doesn't exist anymore.
I did not.
Because she doesn't
I
want
think it's actually available.
The people are asking for it and it's just not here.
Okay. Also, I would take umbrage at brutal defeat. I do not think it was a brutal defeat at all. I'm not even sure
there was 2 hands raised and possibly a third one. Come on.
You know what? You couldn't see everything in that auditorium. This is a fight for another day. But
Sarah, I see everything.
But
I'm a basketball player, peripheral vision, right? This is what we do.
It was dark in there. Anyway, don't miss the gathering, because we are already almost full for the hotel block we have. We have so many people already signed up. So don't miss it. Sign up and you can get to see Logan live and Logan and Sarah live. So thanks so much, Logan. We will talk to you again soon.
See you soon.